I don't know about you, but it is shocking to me to realize that it is not even 3 weeks, it's not even until 3 weeks tomorrow that this bailout bill has been passed. I mean, I don't know about you, but I'm like so totally sick of hearing about it. But I also feel like it's been with us for more like 30 years. I just can't believe it's not even 3 weeks. It's not even a month since the first bailout bill, the one that was voted down, was even introduced. And I thought in the context of these, just those two things that the government has done, we might try to get a sense of, is it even remotely approaching solutions to the problems that the economists and the business people have been illustrating to us? I mean, how are we to think about it? And I think I'll do it in the context of two metaphors that I hear constantly in the news. The first is a medical metaphor. The economy is sick. And so how can we judge it in terms of how you deal with a sick person? And the second is I keep hearing these weather metaphors. It's either a perfect storm of all these things coming together. This morning, Alan Greenspan referred to it as a credit tsunami that has broken upon us. So, and I think it's useful to think about those weather metaphors because, frankly, one of the things I teach when I'm not teaching insurance is environmental law, and I am struck when I teach environmental law, and especially when I talk about climate systems and these emerging carbon solutions, that people also talk about weather as a complex system and how are we to design governmental programs to deal with any complex system. So I want to address how the government is doing in those two ways. Think of it first in the medical metaphor, a sick person. It's sort of simple when you look at how the medical profession addresses a sick person who, say, comes to the hospital. There's sort of a standard three-prong approach. The first is some immediate triage. You have to stabilize the patient. The patient must not die. Everybody agrees with that. But after you stabilize the patient, you haven't even begun to cure, and you have to go to step two, which is then you figure out what's wrong with the patient, and you begin trying to cure. You're going to do surgery, you're going to do chemo, you're going to do something. But other than just keep them alive, you have to cure it, the patient. And then, lastly, there's some sort of rehabilitation, where you get it back up, and it's out of the hospital and out where it's supposed to be. I think it's fair to say that at this point, everything the government has done has been at step one. It's trying to make sure the economy doesn't die. And it's trying to, and the interesting thing that has struck me just for the last month is how it keeps lurching, trying to figure out, well, let's take this emergency measure, let's put a tourniquet on. They go, well, no, he's not bleeding to death, it's something else. And then they try something else. And the thing that I do want to mention that's just interesting and doesn't get much play is despite the confusion, how the government seems, at least in this first stage, to have actually moved in barely this month to a fairly hopeful approach, at least to maybe stabilizing the problem. It was a month ago that the Bush administration and Henry Paulson actually stood in front of us and said, we want $700 billion, and here is the legislation. This was the original bailout bill. I have the legislation. First of all, $700 billion wasn't that long ago when that was the entire budget of the United States. And when it was the entire budget of the United States, the budget document that accompanied it was like this thick. Well, here's a request for $700 billion 1 month ago that was introduced. This is the entirety of it. It's 2 pages. I actually got an extra page. What it is, 2 pages long. And we were told, Paulson said, well, you simply must. If you don't authorize this, we will die. And then Ben Bernanke said the same thing, we will die. And then Bush got on TV and said, you will authorize this or we will die. There was a newspaper out of the University of Wisconsin called The Onion. And it had, I love The Onion, and it had a headline in The Onion, it's like a fake newspaper. And the headline was, Bush calls for panic. And that seemed to be their strategy. I mean, it seemed to be, you must panic and pass this bill. And you all remember, by the way, we didn't. People were so furious that they said, we'd rather die than give you, with no strings attached, $700 billion, plus there's no heads rolling. And there's an element of fairness rather than just living that is important to us. That was actually hopeful. The government then came back within a week with a 410-page bill the so-called TARP bill, the Troubled Assets Relief Program, TARP. And the interesting thing about it is you may, and that was the $700 billion, and that was passed. And that has all the political play that we're hearing in the news now, that second bill. The one point I want to make about that is, do you remember when it was passed, apart from just the residual anger that not enough people are going to jail and so on under this, when people looked at it, people were concerned that the Troubled Asset Relief Program, which proposed to buy what were called troubled assets, no one was really sure at the triage level that this would actually solve the problem. I mean, what about these assets? Are you really sure if you spend $700 billion, you'll keep the patient alive? I mean, the worst case scenarios, we spend $700 billion, but like Tom says, we have a $300 trillion credit default system market we don't even understand, in which case you're just throwing a stone into the ocean and we sink, and it would be awful. And what the plan was, no, don't worry, we will buy these troubled assets, and they were these, for the most part, these securitized, the most vulnerable securitized loans. And it was passed. And if you read the subtext the day after it passed, there was a lot of questions among economists. How exactly are you going to buy them? There were these reverse auctions that no one had any confidence in because of this market for lemons problem. No one knew what to do. And then the interesting thing is that it was passed on a Friday, October 3rd. The stock market dropped 500 points. Then there was a weekend of utter panic. And then Monday, the stock market dropped 400 points. Tuesday, the stock market dropped 500 points. And people thought, oh my God, we're putting a tourniquet on a problem, and that's not the problem. That's what the market's telling us. We're dying, and they don't know what it is. Wednesday, Paulson stands up and says, well, we're going to buy the banks. And I wondered, well, where did you get, I mean, it's good, and it seems, the market seems to say that's stabilized somewhat at the immediate problem, but I wondered, how could you even do that legally? They're not, I mean, buying the banks is different than buying these troubled assets. And I was curious how you could use $250 billion from the $700 billion bailout for that. That didn't seem to be what it was for. The interesting thing is, minutes before it was passed by the House, the definition of troubled assets was changed to mean troubled assets or any other financial instrument. And Barney Frank and a guy named Moran, a representative from Virginia, got on the floor and had a little colloquy for 30 seconds and said, just so we're clear, this change means you can actually use this $700 billion to buy anything, any financial product. And Barney Frank says, that's right. Because they knew that we might need to do that, but that would run into all kinds of flack by people who couldn't imagine you'd be socializing the banks. So they snuck it in. And then, frankly, Paulson just grabbed it. It was a life raft, and after England used the same thing and it seemed to work overseas, we did. And we began to stabilize. It's just an interesting thing that, in fact, we sort of groped our way toward a good solution. Let me make one, and the real issue, of course, is after we're done figuring out the triage and we stabilize the patient, how we actually figure out what the problem was and move into the cure. And there's a lot of issues on that, and there's a lot of issues, too, as to what sort of regulatory mechanism we're going to use and who is going to do it. I will mention just this one point, because we're still not sure what the underlying cause was, and so I'll come back to that weather metaphor. If it was a perfect storm, it was a perfect storm of what? What were these forces that culminated in this horrible thing? And then we have to get to the underlying forces. There was one thought that Tom mentioned that I'll just pick up on because I also teach insurance law. It had to do with these credit default swaps. I mean, the history of finance, and I'm not a financial historian, really over a couple hundred years, is one innovation after another. And these innovations have very good sides to us. Don't kid ourselves. On the good times, we care about these innovations. But the interesting thing about the securitization of mortgages and the credit default swaps that let people make side bets to insure them is that they were new. The market for these credit derivatives in 2000 was about $1 trillion. By 2007, when the stuff was hitting the fan, the market, as Tom suggested, might have been $70 trillion. I mean, to put that in perspective, the GDP of the US every year is $16 trillion. I mean, the real economy. I mean, what is this? And if in fact this thing that has never been out before now meets the perfect storm of the foundation on which it's based, these mortgages is crumbling, what's going to happen? One thought is we regulate these as insurance. I will say this. We actually tried this once before. When Lloyds of London was first formed as insurance, the people at Lloyd's coffee shop would sit and actually make bets, not just on their own lives, but like on the life of the king. And you'd say, well, I think the king is going to die this year. And you take out a life insurance policy on his life, and so would 1,000 other people. They put an end to that for obvious reasons. But the biggest secondary reason was, apart from the fact that there was the moral hazard that someone would kill the king, the concern was it's just gambling, because you are actually putting a bet on something in which you have no underlying interest. And that might, in fact, account for a lot of these credit default swaps, as Tom said, the so-called naked ones. We don't know how these will work. I don't think they should be regulated as insurance. Insurance, as Tom says, is state by state. It's too balkanized, too local. They'll have to be regulated at Washington as a financial instrument by some of these fancy organizations, but they'll need to be regulated one way or the other to move into the second phase and start addressing these problems.
The current crisis is often compared to the situation in the United States during the Great Depression. And so to start, I might look at some comments that business leaders expressed when they had hearings in 1932 during the Great Depression, and they asked them what the problem was. So the CEO of Montgomery Ward is quoted as saying, "To describe the causes of this situation is rather beyond my capacity. I'm unfortunate in having no friends that seem able to clearly explain it to me." Myron Taylor, who was at the time president of U.S. Steel, stated that out of this depression we are going through, we shall have learned something of high importance. He then said, "It's too soon to know what that will be." Now, some thought they had solutions to the problem. Bernard Baruch, who was the advisor to many U.S. presidents and was a sage, at least as his press agent said, he said the solution was balance budgets, stop spending money we haven't got, sacrifice for frugality and revenue, cut government spending, cut it as rations are cut in a siege, tax everybody for everything. Now, this was a prescription for disaster. But Myron Taylor was right, and we did learn something of importance out of that. And what we learned was expressed by Franco Modigliani, a Nobel Prize-winning economist, as the central practical message of John Maynard Keynes' general theory, which was that a private enterprise economy using an intangible money, and today I would substitute having a highly specialized financial sector, needs to be, can be, and therefore should be stabilized by appropriate monetary and fiscal policies. Now, Ben Bernanke, as an academic economist, was a very careful student of the Great Depression. And in general, not just a student of the Depression as a whole, but of the role of credit and of the banking system in the Depression, and more generally, the importance of credit in the transmission of monetary policy and in macroeconomics as a whole. And the application of Keynes's message to the current financial crisis, and it's not exclusively Keynesian, this isn't really a controversial point about schools of macroeconomics, but the general message there is that the Federal Reserve, or central bank, is the only agent in the economy that has the will and the ability to expand its own balance sheet, create liabilities on itself, which are assets to the financial institutions and other institutions that enable them to provide credit to the economy, and they're the only institution that can really prevent massive amounts of failure of financial institutions. So that's the lesson that we learned from the Depression, and that Bernanke in particular has definitely taken in. So what did the Fed do? And I want to talk only about the Federal Reserve response to the crisis, and just because that's what I have time for, and it'd be a different kind of a verdict perhaps if we talked about their role in the inception of the crisis, and then a completely different topic as to what will be their role in getting to the cure of this crisis. But let me just give you a few steps. Beginning in September of 2007, the Federal Reserve Open Market Committee began to lower the target federal funds rate. During the period since then, it's gone from 5.25% down to 1.5%. The Fed began the loan auction program in December of 2007 when it became clear that banks were reluctant to lend freely to each other. That program's been expanded several times. In January of 2008, they set up a term facility to make funds available to banks for periods longer than overnight. This program's been expanded also several times. The Fed opened the discount window to primary dealers in government securities, basically investment banks, in March after the failure of Bear Stearns. When lending to these financial institutions didn't result in adequate freeing up of credit markets, earlier this month they started to lend directly to corporations, so to bypass the banks that just sit on the funds that they get and lend directly to the corporations. And last Monday they began an initiative to lend to the issuers of money market funds who are hesitant to, in their turn, lend to financial institutions because they're afraid they won't be able to keep the value of their funds at $1 to $1. So the Fed has said, if you need money, come to us, give us the commercial paper you have or those bank CDs you have, and we'll give you cash. So these initiatives have increased total borrowing from the Federal Reserve by over $500 billion in the past year. And if you look at the expansion of loan facilities, it's been even greater. The money market initiative alone is $500 billion. So the Federal Reserve has responded in large numbers, larger than the numbers we're talking about for allocations of money by Congress. And they've been broad in scope and imaginative in the ways that they go about this. So why do we still have a crisis? If we get to this medical analogy, we could say, well, the patient could say, well, Dr. Bernanke, you're a very smart guy and you're giving me a lot of medicine, but I'm still awfully sick. What's going on here? Well, I think the Federal Reserve has to date been constrained in three ways. First, a solution to the overall crisis requires measures that are beyond the sphere of what central banks can legitimately do. The Fed's been operating on the boundary of that sphere using a provision in a Depression-era statute that allows them to lend in cases of financial exigency to any corporation, partnership, or individual. So they're operating at the boundary, and back in the spring, even Alan Greenspan and Paul Volcker were telling Ben Bernanke that you're at the edge of what a central bank should do. If you're going to recapitalize the banking sector, or if you're going to buy up massive amounts of these troubled assets, then you're putting large amounts of taxpayer money at stake, and the taxpayers deserve to have their representatives involved in that decision. So it was necessary to bring Congress, albeit kicking and screaming, into this process. Choosing which institutions to let fail, whether to bail out AIG, bail out have Bear Stearns incorporated by JP Morgan, or let Lehman Brothers fail, those are decisions that the Fed feels very uncomfortable making. So it wasn't surprising that in the weekend after the weekend in September, when Lehman Brothers went down and AIG was lent $85 billion, that Bernanke asked Paulson to go to Congress, and Congress didn't want them there. They didn't want to be asked to make a vote on this before the election, but they went there and told them the patient was dying. The patient was in bad shape. So this process has begun. Secondly, other central banks really need to be part of the process before you get to a solution of what's really a global financial crisis. As the Fed lowered interest rates over the course of the first half of 2007, the European central banks didn't. The European central banks were very helpful in the crisis in terms of putting a lot of liquidity into the financial markets, but they didn't lower interest rates. The result of that was that the spread between the European rates and the US rates was really pushing the dollar down. And by the time he gave his speech at Harvard in June, Bernanke expressed the worry of the Fed that there could be a dollar crisis. Now the other central banks are more on board, both in terms of the last cut in October 15th of a half point in the funds rate was also a cut made by the Swedish central bank, the Swiss central bank, the Bank of England, the ECB, and so a unified cut. The third constraint was until recently commodity prices were rising rapidly. The oil price had hit $145. That's a big constraint on the Fed. They want to encourage the economy to grow, but they worry about inflation. The last time they were accused of being behind the curve was in the 70s when inflation got out of hand, and they don't want to see that happen again. Now commodity prices are coming down, oil most dramatically, but other commodity prices as well, so they're freed of that constraint. So what can we expect? What I think is that we learned a lot. Myron Taylor was right. We learned a big lesson from the Depression. The Fed on its own will prevent that. They have the tools to prevent a financial meltdown that would lead to something like the Great Depression.